Hi, I'm Judith Panero, the Executive Director for AAMC and AAMC Foundation, the leading organization for all art curators serving many, not few. It is a pleasure to welcome you to today's virtual discussion. Thank you for joining us. We hope that you, our community of colleagues, allies, and supporters around the globe are healthy and safe. In 2019, we held over 50 programs bringing together more than 1,300 individuals from 19 countries, providing an exchange of information on critical topics for the nonprofit arts community. Since early March of this year, our work has continued to address ongoing issues in the visual arts organizations, as well as concerns rising from the current pandemic. We've greatly enhanced an already robust online programming calendar by presenting varied offerings, such as the one we are gathered together for today. With your participation and feedback, we continue to ensure we are addressing the needs of our audience and moving the field forwards towards an equitable, inclusive, and sustainable future. For many years, we have been presenting webinars, virtual programming, which are accessible on our website through archived recordings. You can also find information on upcoming ones on our website as well at artcurators.org. We hope that they provide actionable advice, value, and connectivity. We welcome all nonprofit art curators to join our organization. Benefits of membership include networking with our global audience, access to discounted and free in-person and virtual programs and fellowships, and importantly, the opportunity to be part of a unified voice for and of curators. Additionally, our foundation serves the larger curatorial and arts community, and should you wish, donations are welcome from you as an individual, a corporation, and/or foundation. Any amount will have direct impact on our work. You can see options for donating on our site. Thank you, and I hope you enjoy the program.
Hello, good afternoon, and welcome. In case we didn't meet at last week's webinar, I'd like to quickly introduce myself. My name is Debbie DiVito. I'm a director and private banker at Citi Private Bank. My job today, though, is to guide you through this presentation. On behalf of my friends at the Association of Art Museum Curators, I'm really excited to welcome all of you to today's webinar, Retirement Planning Now. Just like last week, today's webinar will follow a seminar format. We have two speakers, and we'll devote the last couple minutes to answering any of your questions. So please, please, please use the Q&A button below to submit your questions throughout the presentation. That way we'll be ready to answer them at the end. So now I'll just quickly welcome and introduce my two friends, our two speakers, Marina Rodriguez, who is a financial planner and vice president at Citi Private Bank, and Avani Ramnani, who is a director of wealth management and financial planning at Francis Financial. If you'd like to learn more about Avani or Marina or me, please feel free to take a look at our bios at artcurators.org. Marina and Avani, welcome back. If you were with us last week, I offered you a market update and my reasons for maintaining optimism despite the broader landscape. As I said last week, though, I'm very aware and sensitive to the fact that we've all been personally and professionally affected by this pandemic. Our concerns these days are big: the physical and financial health of the people we love, as well as social issues and unemployment. Those are the things keeping us up at night. And these concerns are valid and ongoing. So how do we pave the way for stability, control, and dare I say it, optimism? As I said last week, we've learned a lot about COVID in the past weeks and months. We know what leads to spread. We've learned the precautions we need to take to keep ourselves and our families safe and healthy. As it relates to the economic damage we've seen so far, I talked about it last week. This is a man-made crisis, largely so. And that's because before now and before 2020, no one in the history of the world had ever voluntarily shut down the economy. And in the past few months and weeks, we've seen the havoc that wreaks on the world around us. But as I said again, the government aid, the stimulus packages, they were swift, they were effective, and we've seen businesses start to slowly reopen around the world. The signs that we see, the green shoots, are telling us that we're going to be okay. In the second quarter, the S&P 500 showed us gains of 20%. That is the best quarterly performance in the past 20 years. Unemployment numbers, and something that certainly is top of mind for today, they're still high, but they are going down. And the majority of the individuals who are unemployed, as I said last week, they expect to be so on a temporary basis. But for some of us, and perhaps for certain people on the phone today or on Zoom, unemployment is a current and potentially permanent reality. For others, the data alone brings retirement to top of mind, and that's why we're here today. We want to serve as a resource to you, your teams, your families, and for anyone who's anticipating or thinking about retirement in the next 5 years. Today, Avani and Marina will talk about what's happening in the world today, like the new coronavirus-related loans. They'll also, share steps that you can take to assess risk and increase retirement benefits. As I said last week, I'm a private banker. It's my job to direct my clients to the right resources to accomplish their personal financial objectives. Last week, I told you that in the past 5 months, the most important role that I've taken on is one to help my clients move from a fear mindset into one of growth. Again, today, Marina, Avani, and I, that's exactly what we want to do. We want to give you resources to help you plan for retirement and to move from that fear mindset into one of growth and, again, dare I say it, optimism. So we hope that you enjoyed today's presentation. We hope that you learn a lot, and we again encourage you to ask questions. We have a very intimate group of folks on the phone, so if everyone has a question, I can almost guarantee that we'll get to it, and if we can't, then we will follow up with you separately after the presentation. So thank you for being here today. And now I will pass it over to Avani, who's going to get us started today. Avani, over to you.
Thank you so much, Debbie. Thanks a lot. We'll share the presentation. I know, there we go. And today we are here to talk a little bit about retirement planning. And I love to think about retirement planning in the sense that, especially now, retirement means a very different thing, something very different than what it meant maybe even 30 years ago. And it means different things to different people. So we would love to cover different aspects of retirement planning. If you could move to the next slide, please. We'll talk about how to develop. What do you think about when you're developing a plan for retirement? The different aspects of spending, saving. How will you get from where you are today to whatever that goal might be in the time frame that you're looking at? We'll talk a little bit about investments and how to invest, and then visit some of the COVID-19 related changes that are impacting the retirement rules around saving, rules around loans, distributions, and so forth. And then really talk about how to retire in a recession. Where we have some, we've seen some fears in our clients who are talking about retirement, and I'd like to just share a little bit about that. If we move on to the next slide, this is talking about what are your goals. So I feel like if you don't know where you're going to next, it becomes very difficult to create a path to get there. So think about, I highly encourage you to think about, what is it that you want to do? What does that next step look like? And it doesn't have to be, oh, I'm going to, stop working and just move to Florida or something like that. There are so many different things that can happen during retirement. You could decide to travel. You could take up a new like a new profession. You could go back to school to study for something, get more involved in your hobbies, play sports that you've been planning to play but haven't got a chance to do, or get more involved with your families. So there's so many things that you can map out in your retirement. And once you map that out, it becomes easier to take that step and to really think about what retirement might, what type of things you want to do in retirement. If you could move to the next slide, please. So when it comes to developing a plan for retirement, some of the things you need to think about is, how much money will I need to retire? And, how do I save for this money? What should be that goal? Is there a magic number that if you save this much, you're totally fine? How will you get there? From where you are today, what steps do you need to take to be able to retire comfortably? And the way I encourage clients to think about retirement is to think about it in a long term. So even if you say, okay, I'm going to retire at, pick a number, right, age 65, and then I'll retire at age 65. The point is that when you retire at age 65, given the life expectancies right now, you could easily live for another 30, 35 years without even thinking about, even longer, right? You could live up to age 9,500 pretty easily, which was definitely not the case for our parents. Our parents would say, oh, I'll retire at 60, and then their life expectancy was maybe another 15, 20 years. So it meant very different things to them, and which means, if you do have a long life expectancy, probably need more money during retirement to support your retirement. So really to think about what that amount could be. Now, it's different for different people. If you could move to the next slide, please. There are so many different numbers that people come up with that I remember there was an ad a few years ago for a bank or something where they would show like my magic number and really how much you should be saving towards retirement. And the way to think about it is, what is your income in retirement and how much your expenses are going to be. So when you're thinking about saving for retirement, it needs to be as much as you can. We definitely recommend about 15% of your gross income. So without before you take out the taxes or any other deduction, whatever your real income is, your gross income is, you save about 15% of that. And it doesn't have to be in a retirement plan per se. That's a great option to do. But, the only magic number I feel like is that if your employer has a match that they will do in your retirement plan, you should save at least that much. The sooner, the better. The earlier you start saving, the earlier your money can start working for you. And really, you work very hard for your money. So your money should be working very hard for you. So save, the earlier you start saving, the better it is. Today is much better than tomorrow or day after tomorrow. So that's what I say about that. The more, the better. So, the more you save, the better it's going to be. Of course, you have to manage your current cash flows, but really thinking about how important is it for you to have that life in retirement, and what are you willing to give up for it today if that is something that you must do. Sometimes it's easier to say, okay, figure out what that retirement savings needs to be. And once you've saved that, and you can spend your money wherever you want. There are no restrictions. So, these are just some of the things that I encourage you to think of. Next slide, please. Some of the information, to come up with what that number could look like for you is, and there are so many calculators out there that you can use. I've given a link to one of them here. There's a calculator on T. Rowe Price. I know Vanguard has one. Many different institutions have these calculators. And some of the inputs that you need to put in them is when do you start saving for this? At what age, at what age will you retire? How long your retirement will last? How many people are you planning for? Is it just one? Are you married? So you're planning for 2 people's retirement. What are your assets so far? How much have you saved so far? What are your monthly income goals? So think about it, when you retire, hopefully have at least some Social Security coming in. Maybe there is some pension or not, but that will determine what your, all these different pieces come into your income calculation. So what that income needs to be from your portfolio is a different calculation. And then, what your portfolio is right now, whether it's retirement assets or non-retirement assets, and then success rates. So different calculators do it differently, but some show you what your likely rate of success is if you did those different, if you had those different criteria or assumptions going in. Next slide, please. So this is one of that T. Rowe Price used to look like this. I think it still does a little bit. So you put in what your retirement age is, what your length of retirement might be, your marital status, what your assets are right now, what your income goal is, and then it will come up with a success rate. So for example, in this example, your monthly income goal of $4,500 was not met in this simulation, and the success rate of 80%. It was a success rate of 80%. But you can modify all these numbers to look at what it means for you, and that's why there's no one number. Way back when, I think many years ago, people would think, if I have $1 million saved for my retirement, I'm all set. No longer the case, unfortunately. It depends on where you live and how much you spend and so many different things. So that's really something, that's a good starting point. And as you get a better handle on things, you can refine these calculations too. So next slide, please. And some of these things, and I'll call on Marina to jump in now and talk about this next piece of how will you get there as you think about these retirement scenarios.
Thanks, Avani. So what we're going to cover again next is kind of different sources of retirement income. So Social Security being the first, which is usually based on how many years you've worked and the earnings that you've had during the period that you're working. And we're going to cover a little later kind of pros and cons of early versus later and what that means. It could be continued employment earnings. So Avani had discussed early on in terms of retirement maybe looking a little bit different. You can kind of formally retire from your employer, but you may want to pursue some sort of passion project and start your own business. So there can be continued earnings after you kind of formally retire before actually fully ceasing to work. And then the other source, it really comes from your savings. So that is everything that you kind of manage to accumulate while you're working, and it's generally split up into two categories, the first being tax deferred. So what does that mean? Tax deferred are dollars that you have put into things like 403Bs or 401Ks and IRAs that are growing kind of tax deferred over the period of time before you start drawing on them. So any kind of dividends, capital gains associated with, you're not paying along the way. You pay the taxes later on, and the pool of money that goes in there is usually tax deductible. So meaning contributions, for instance, to retirement plans get put in before any taxes get pulled out, which is why you pay the taxes later on. Versus taxable kind of pools are your savings accounts, your portfolio assets, so any investments where you are paying the taxes along the way. So that could be on interest, again, capital gains and dividends and things like that. Next slide, please. So Social Security, the age that you are able to receive the full benefit is dependent on when you were born. So for those that were born kind of prior to 1942, kind of between 1938 to 1942, it's about 65 years, and the month will depend on your year. If you choose to take that early, so earliest you can take Social Security is age 62, the amount that you would receive off the full benefit is actually something closer to about 80 to 76%. So let's just say today, for instance, kind of Social Security at full retirement age, again, it depends on earnings, but let's just say it's $3,000 a month. Instead of getting the $3,000 at age 62, you would get something about 75% of that. If you are born between 1943 and 1954, its full benefit age is 66. And then for anyone kind of, and you can see the chart, anyone after 1960 and later, you have to wait until 67 to receive the full benefit. And if you take it early, you would only receive kind of 70% of that total amount. And that is for the rest of your life versus kind of waiting a couple of years. So instead of taking it at 62, taking it at 67, or what some people actually opt to do if you don't need it from a cash flow standpoint in retirement is wait until age 70, because every kind of year you deferred, it's about an 8% kind of growth rate on that. Next slide, please. So where can I save for retirement? For those listeners on the phone, kind of the primary source is a 403B, and that is a retirement plan for employees of tax exempt and public schools. You can contribute up to $19,500 for this year, and if you're over age 50, that amount goes up to $26,000. The dollars that you put in are tax deductible. Again, that means that you're not paying kind of income taxes on those dollars, and tax deferred because you pay it later on when you start drawing on those funds. And similar to 401ks, certain 403bs offer Roth options. So we're going to kind of cover that in a moment, but generally Roth you put in after tax dollars. So basically any withdrawals that you take into the future, there are no taxes associated because you've already paid the tax upfront. And then this is kind of unique to 403bs, is you can take it in the form of an annuity contract. So what does that mean? An annuity contract an annuity is generally an insurance product where the insurer provides a promise to pay the account holder, so that would be our listeners, a specific amount over a specific period of time. So it kind of depends on the underlying terms, but that could be for your lifetime. It could potentially be for kind of joint life with your spouse. And there are kind of different options to consider within kind of annuities in 403Bs. There's fixed annuities, which means that the insurer pays an interest rate. So there's kind of like a minimum, potentially guaranteed amount of stream of income, and that's kind of a really good source of principal protection. And there's something else called a variable annuity, where you're much more subject to the market, and similar to what Avani covered in our first kind of session in terms of different types of investments and stocks and bonds and mutual funds. So a variable annuity is something that works very similar to a kind of mutual fund where there's a basket of underlying securities. So you are kind of subject to market risk. But the insurance sometimes will provide almost certain floors. So they are a bit different. The only thing I would kind of caution in terms of those products is they are a little bit more intricate, and there are other layers involved. There are additional fees that you may not find in traditional kind of offerings within 403Bs on the mutual fund side, ETFs or things of that nature. So it's important to understand what you're investing in, and again, ask the right questions and make sure you've kind of weighed all the pros and cons and associated costs and risks for the particular investment. Next slide, please. So other sources of savings, 401k plans operate very similar to 403Bs that, you know, for any of our listeners that may have spouses or significant others that they're with that are part of kind of private institutions. So Citi, for instance, I'm an employee of Citi and I have access to a 401k. So they work really similarly. Again, those are, you know, tax deferred, tax deductible, and then tax deferred later on. Then other sources are traditional IRAs. So the amount that you can contribute for 2020 is $6,000, with you being able to contribute up to $7,000 if you're over the age of 50. In order to contribute to an IRA, however, you need to have earned income. So if any of our listeners happen to be primary breadwinners, one nice thing about kind of being able to kind of maximize savings in these tax deferred vehicles is you can actually also contribute to your spouse's IRA. So even though they may not work, you're actually able to put money away from them because you actually have earned income. There are income kind of limitations, such that if you're below a certain income level, you can take this as a kind of, there's a tax deduction that you can take advantage of. However, you are still able to contribute, you just may not get the tax deduction up front if you're over a certain amount of income, but still a really great source of savings. The other option is Roth IRAs. Again, same kind of max amounts in Roth, same requirement for earned income. The biggest difference is that Roth IRAs, there is no tax deduction. So all dollars that you draw on them in the future are completely tax-free. And sometimes I get the question of, you know, why should I contribute to a Roth, or how much should I contribute to a Roth? It's, you know, that the answer is unique to every individual, but some things that you want to consider is, again, from a cash flow standpoint, if you kind of max out in one area and you want to take advantage of another, or you're not going to get the deduction anyway, you may want to do it to a Roth IRA versus a traditional IRA, as long as you have the savings. And there's also, you know, where we're kind of in the midst of a potential kind of change in administration, and one of the biggest forms is, you know, usually those changes are associated with taxes. So if you have kind of strong convictions that taxes could potentially go up in the future, you may want to kind of start putting money into Roth and taking advantage of Roth options within retirement plans, or simply just thinking about having different streams of income in the future, right? So you may, you have, you maximize all the savings in your retirement plan, but all those dollars are going to be taxed in the future. So wouldn't it be nice to have kind of another source that is still growing, kind of tax deferred, right? You have all that tax-free growth happening behind the scenes that when you draw on, it's completely tax-free to you. So just different sources. And there is one more thing that I will mention, only because I mentioned it previously about I had mentioned it in terms of goals and potentially looking to do something later on, but some people have kind of side businesses, or I think the popular term now is called side hustles, where you're earning kind of income for yourself in addition to your current full-time job. And a really nice way to also shelter some of those savings is, again, as long as you can from a cash flow standpoint, is something called a SEP IRA. And that's something to take advantage of if you are kind of self-employed as an individual. Generally, it's subject to how you structure your own business, but let's assume you're kind of just completely a sole proprietor. You can put away up to 20% of your kind of net profit. So that's whatever profits you have after paying Social Security taxes. And you can actually do that in addition to maxing out your 403b or 401k. So it's a really nice way of kind of, again, maximizing savings. Next slide, please. So how should I invest, right? We just discussed different ways to save. So how should I be investing this dollar? Should I be aggressive or safe? So options when thinking about investing are really popular ones are retirement date funds. And for those of you who listened into the first session, you can kind of associate this to set it and forget it. So retirement date funds, you pick a date in the future. So say, you want to retire 20 years from now. So the date is 2040, you pick a 2040 target date fund, and it's a basket of securities that will naturally get more conservative over time. So they start out kind of based on how much time you have left until you need to draw on those funds. So they can start off being more aggressive and more equity oriented, and winds up being very kind of, or more balanced and conservative toward the end. And so for those of us that, maybe don't want to look at your retirement plan every single day, or don't know when should I be switching to be more conservative, this is kind of a nice way of almost having it on autopilot. Another option is mutual funds. So mutual funds is a basket of securities. There's a money manager that's kind of picking the individual stocks and bonds, and mutual funds can either be a basket of stocks, could be a basket of funds, but there are all sorts of mutual funds always coming out to the market, and it can be a combination of those things. So kind of just, I would caution, do your due diligence, make sure you understand what the investment mandate of the mutual funds is, right? So if it's investing in dividend-oriented stocks, make sure that they're following their mandate. Other ones could be something of kind of following kind of macro issues, so they can be kind of go anywhere. So just be aware of what the investment manager of the funds is really trying to do, and does that make sense for you, and are you comfortable with it? And then again, there's a whole range, a whole spectrum of, let's call them risk tolerance, from aggressive, moderate to conservative. And what does that really mean? We're gonna see it visually on the next slide. So perfect. So aggressive versus safe. So aggressive generally means stocks. So this is a kind of the highest gains and the worst annual loss over a period of time. This particular chart is showing returns from 1926 through 2014. So we're covering an 88-year period of time. And this does include things like the financial crisis, the dot-com bubbles, right? These are kind of very common kind of things that we associate with kind of market kind of crashes or recessions and things like that. It also incorporates the Wall Street crash of '29 that led to the Great Depression. So we're really capturing some bad timing here, some bad times in the market. And so what you'll see is if you were 100% in equities, which is that first circle that's all in red, you could have gained within a year at the hot, like the most of 54% or lost 43%. Versus having been in bonds all the way on the opposite side is the circle that's completely in blue is you could have earned 32% in any particular year or lost about 8%. And everything in between, right? So that kind of gives you a sense of what does it mean to be aggressive versus safe. Next slide, please. So how should I invest, right? So we discussed where should I invest, the different forms to leverage investments, but how do I know what's appropriate for me? So there's different types of kind of software out there. This is coming from CNN.com, an asset allocation wizard, but a lot of our retirement plans have similar kind of questions in terms of what the asset allocation should look like. And it's asking you kind of, and Avani covered this earlier in the slides, is how much do you need? So, you know, it's going to do this more on a mathematical basis, right? So it's going to take your time horizon. So when do I need these funds? And then it's going to ask you other things like how much risk can I handle? And then, so these are kind of tools that you can leverage in order to start getting a sense of how should I be allocated. And this will give you a recommendation. But beyond that, next slide, please, is not only thinking about kind of time horizon and how much time do I have until I need these funds, or how much time do I have over my lifetime, right? It's also how do I feel? For the financial crisis, it's asking, how did that feel to me? Was I okay with losing that money, knowing that, generally markets snap back, right? We have a long-term history of showing that markets come back. But did you sell? Did you hold on? Did you buy more and see that as an opportunity? And then in terms of kind of market fluctuations is, this site on Vanguard will also get into kind of the feelings of, do I kind of prefer kind of volatility, no fluctuation of volatility, or am I willing to accept a lower, and am I willing to accept a lower return for these investments, or vice versa? Am I willing to kind of not accept that much because I'd like to be conservative. I think most of our listeners are women. I will say that women generally are really great savers, but they tend to be a little bit more conservative, and that's okay. But I think, being cognizant of what does that mean? If I'm going to be more conservative and I'm not comfortable with taking that risk, and I'm going to accept a lower return over a long period of time, that may mean I need to save more and cut back in certain areas, or I may need to work longer in order to have my financial goals met. Next slide. This is just what we were mentioning before in terms of target date funds. This shows you, again, this is a visual graph that shows you how things evolve over time. So if you're 50 years away from retirement, you will see the red area of this chart is more skewed towards equities. And as you get to retirement, that starts getting lower and lower and lower, because really equities is where the growth is going to come from, or the opportunities from growth generally. And as you get further into retirement, that'll become less and less and less over time. Because as you get closer, typically you want to protect that principal, because you're not going to have as much time to recover from potential downturns in the market. And I will just remind everyone as we're going through, I know we're covering a lot of questions, a lot of material, so please ask questions as we go through the slides, so we can answer them at the end of the presentation. Next slide, please. And so we talked about just kind of these general categories, right? So equities and stocks and things in between. This chart is, I think, a favorite of most kind of advisors or people managing money. We call it the quilt because it looks like a quilt. But this is showing you the kind of returns by year for different asset classes. So this is going to encompass cash, stocks, and it'll separate stocks into large cap stocks. So Citi would be considered a large cap stock, or small cap, which is kind of like small, think of like more small businesses or growing businesses. It'll include things like fixed income. So what you're seeing here, really the takeaway here is that there is no real consistency, right? There's a lot of factors, kind of macro factors, as well as micro, so individual companies that will affect how things perform. But if we're talking just about asset class, at the asset class level, there will be times where fixed income is actually doing better than equities for a variety of reasons, or vice versa. So if you look here, what you're seeing is these colors are all spread out, because nothing will consistently earn a specific return over the long run. So it's important to have a diversified mix in order to kind of soften that ride, right? So if you are all in equities, you will experience kind of all the highs and lows. But if you have a mixture of things that are returning things differently and behave differently depending on different market environments, hopefully you're getting a healthy return, but moderating the potential downside. So diversification is key, is just having, again, a broad basket of different asset classes and securities to kind of soften the ride and get you to where you need to be for your goals. And now I will turn it over to Avani, who's going to be discussing specific kind of things that relate to what we're living in today, how to take advantage of them, and how to plan for retirement in the current environment that we're in.
Thank you, Marina. Yes, so let's talk about, Marina gave us some really good information about investing and other, and related aspects. And we just do a little bit of a shift to talk about what's going on now, what are the changes in some of the rules that have come into place to help people deal with this crisis that we're going through. Some of the changes have been made around required minimum distributions. If you already are above a certain age, that they've changed that age too, but if you're above 72, you're required to take minimum distributions out of your retirement accounts if you've stopped working. Now these apply to, those required minimum distributions for the year 2020 have been suspended. The thought behind this is that if you don't need that money to come out of your retirement account, you can save it. You can save it for later years. In 2020, if you don't really need to take money out, you can keep that money in your retirement accounts for it to grow for one more year. So this applies to not just your retirement accounts, but also if you were beneficiaries of an inherited account and taking stretch distributions, you could also delay those distributions. Next slide, please. Thank you. So some of the coronavirus related distributions. So these are accommodations that have been put into place where you can take advantage of some of these rules if you are suffering right now. If you're financially in a position that you must take money out of your retirement account, then these are accommodations that the government has made so you're able to bear the hardships that we're seeing because of coronavirus. So you can take distributions of up to $100,000 from your IRA account. And if you're below age 59 and a half, then if you took money out from your retirement account, you would otherwise have to pay a penalty, a 10% penalty, but that 10% penalty for early withdrawal is waived for 2020. So you no longer have to pay that extra 10%. You still need to pay taxes, and there are some accommodations I'll talk about, but on top of the taxes, you would have to pay a 10% penalty, which for 2020 has been waived. So that's a really good relief for taxpayers. Now, if you do decide to take that money out of your retirement account, you must pay taxes. You had to otherwise, normally the rule is that you have to pay taxes all in 1 year. But in order for this relief to happen, they have said that you can distribute that payment of taxes over 3 years. So you can take 3 years to pay those taxes. And if you decide that, you know what, let's say in 2021, your financial situation improves and you say, hey, I don't really, I have now money to put back into the retirement account. I can put back the money that I had taken. You have 3 years to be able to do that. So in 2021, 22, 23, you're able to put the money back into your retirement accounts for whatever distributions you had taken related to coronavirus. You have to meet some criteria. It's if you're directly affected by the disease, by COVID, or someone in your family has been affected, or if you can show that you had to stay home to provide care for your children and you couldn't go to work and lost your job, any of these will qualify you to be able to take advantage of this relief. There are some others too that you have to self-certify, but they are available to you. Next slide, please. The CARES Act, they've also increased the amount of loan that you can take from your retirement plans. So in the previous slide, we talked about distributions where you just take the money out. But here, what we're talking about is just a loan. So you are able to take a loan from your retirement plan, and normally that limit is up to $50,000 or up to 50% of the total assets in your retirement plan. And for this year, they've removed that $50,000 limit and that 50% limit, and they've said you could take it up to $100,000. So again, each plan is implementing this a little bit differently. So talk to your plan administrator if this is something you're interested in, figure out what makes sense. But you're able to take up to $100,000 of maximum amount of the value of the account, the vested balance of the account. And then, when you take that loan, you have to start making repayments on that loan. And that too, the repayments have been delayed by up to 1 year. You don't have to start, under normal circumstances, you would have to start repaying that loan right away. But under the CARES Act and the COVID provisions, that has been delayed for up to 1 year. Now, is it a good idea to do this? My thought is that this should be the last resort. If you have no other sources of funds and you must dip into your retirement savings, only then would I ask you to look into this. But if you need it, it's available to you. Next slide, please. Thank you. So just now taking a step back and looking at, you know, what should your portfolio look like in retirement? And here's something else that I encourage you to think about. Even if you are retired, you likely have a very long time horizon in front of you. So your portfolio could be invested for 30 or more years. Even if you're retired age 65, you have a long life ahead of you, through which this portfolio needs to provide you your support. So think about how to invest your portfolio, keeping in mind that you do have a long time horizon in front of you. Now, if you remember back in March and April, the stock market did something it has never done before. It fell by like 33% in like 2 weeks. And we've never seen that type of fall before to that extent so quickly. But historically speaking, from a long-term history, if you look back, you know, 70, 80, 100 years even, the average time it takes for the market to return back to its all-time high after a short correction. So a short correction is something that, you know, the market will see on a regular basis. So if it's a small correction, then it takes about 10 months for the market to come back to its all-time high. And if it's a bear market, a longer term bear market where the market is down for more than a few months, then it takes about 24 months to come back to its all-time highs. In this situation right now, the market is back almost up to the level where it was back in December, which is, you know, again, unprecedented, and I've grown tired of saying that word. So it's just been a very interesting time where this recovery has been pretty quick, but know that even under normal times, the recovery is not that bad. It doesn't take that long for the market to recover. So think about your investments from that perspective, that you do have a long time. You do have that time to recover. Now, if you were age 90, I would say, okay, then it's reasonable to think that you don't have such a long time horizon in front of you. Although, you know, I know someone who's coming up to age 100 and it's just fantastic. She's still very healthy and, you know, very much very in robust health. But you know, that's when you think about making, you know, about your portfolio differently. But when you're 65, 70, you still have a long way to go. So always remember that. And then the other important key thing to remember is that your portfolio is not the market. All these talking heads you see on TV, you know, going nuts about the market fell this many points. Your portfolio is not the market. You are not 100% invested in those stock indices that they're talking about. I'm hoping. Marina, you know, went through a lot of diversification and those types of concepts, and I'm hoping that your portfolio is very well invested, well diversified portfolio. So remember that your portfolio is not those indices that the talking heads are talking about. Next slide, please. How to retire in a recession. I want to, for everyone, I don't know if you remember, back in the last recession, this happened in 2008, there was this whole thing about the lost decade, right? So many people talked about it, and I may be dating myself here. but so many people were talking about the lost decade, that people have lost all the money that they made in the past 10 years and it's just poof gone. But the market rallied after that. I think it was like 16 months or maybe 18 months, after which it was almost back to where it was before this recession hit. And so my message to you is that if you are close to retiring, if you're already retired or are close to retiring, don't panic. Please don't panic. There is no need to do anything on a knee-jerk basis. Yes, you do need to take stock and pay more attention to what's going on. Know your immediate cash needs. What are the things that are really critical that you need cash for? What are some of the things that can be pushed out? So just take good stock of that. The next piece is really think about how risky do you want your portfolio to be? And I'm going to talk from both, it might be contradictory a little bit, but think about it as trying to gain a balance. So on one side, what happens with, and it's an emotional thing, right? When the market's doing well, you think like, oh my God, I'm missing out on this, how well this market is doing, and maybe I should invest more in some of these stocks. Oh, how come I'm missing out? So you tend to make your investments to be more risky. But at a time like this, when there is a recession and there are so many alarming news articles and news clips that you hear, you feel like, oh my God, I want to move to the very opposite end and have all my money in cash so that the market can't touch it. You have to come to a happy balance and really assess what your real risk tolerance is, risk tolerance and risk capacity. There are so many strategies out there if in a volatile market that you can take advantage of. If some of the parts of your portfolio haven't done well, then take those losses and save those, because you can put them against gains. And this is a whole tax saving strategy that you can implement. And then, how long can you take distributions before you're forced to sell investments that may be down because of the market right now? And then the bottom line, I love this piece. You don't need 100% of your money in the first month in retirement. Think about it, right? This money needs to be there for the rest of the time that you're retired. It doesn't all have to come out in one go. So even if the market is down on the day you retire, it's the worst day in the history of the market. It's okay, because you don't need to sell all your investments and take all that money out, 100% of it, on that first day of retirement. So keep that in mind. You still have a long-term horizon in front of you. Next slide, please. Thank you. Again, don't make any drastic shifts. You don't know. No one can consistently predict what the market is going to do. So whatever it's doing right now, don't make big changes in your portfolio. Don't take any big decisions about your finances based on what's going on right now, because you are driven by emotion at a time like this, and it's just not a good idea to make long-term financial decisions when you are emotionally charged. And, we do feel like we need to take action, but the best action may be to just not take any action. Next slide, please. I know we're running a little bit out of time, so I'm going to rush through some of this. What are your options? Can you retire a little bit later? Can you have one of those passion projects or a side gig while you're doing this? Can you change some of your hobbies or some thing you're passionate about and use that to make some money while you're in retirement? How can you change your expenses? Can you shift some of those expenses around so that your income needs go down? and look at your spending again. I always say, spend money, but spend it on things that are the most important to you. So review your expenses and think about, is this really important to me? Is this bringing me joy? And if it's not, then, that's an easy target if you do need to get rid of some spending. Next slide, please. Oh, and we're up to questions. So if you have any questions, please put it in the Q&A box.
Avani, thank you so much. That's been incredibly helpful to me personally, and clearly to my 3-year-old who made a cameo. She was just so compelled by today's content. She had to come take a listen for herself. I'm happy to report that we've got some really great questions and some that are very specific. So I thank you, everyone, on the chat today for your questions. This is wonderful. And if you want to get even more granular, again, all of our contact information, our bios, it's on artcurators.org. So feel free to look us up if you want to go a little bit deeper. This first question, I think, Avani, since you were just talking, I think I'll kick it over to you. One of the things we talked about in our last session is this idea of having the right professional to talk to about these questions. So I think that would be helpful to kind of talk about just very broadly, once we get off today's call, what are the resources you can look to continue this dialogue? But then also a part of that is one question we have from a participant is that my 401k is managed by a firm who works for my museum. I want to retire in 5 years. I have a conservative approach. Should I be relying on my financial planner to ensure that diversification, or should I be involved in that?
It's a very good question. So, I think that when you're close to retirement, you really need to get a professional involved. If you don't feel confident, for example, my retirement planning, I would likely also get a professional involved if I'm so close to retirement. The reason is that you need that third-party perspective on what your situation is. You're too close to your money to be able to make an objective decision and look at a situation objectively. So I would, if it's not too much of a financial burden, I would highly encourage to rely on a professional, and on a professional you trust. So if you have a relationship with this financial planner who's working with your firm, if you have a relationship with them, if you feel like you can trust them with all this intimate information, then that may be a good place to start, and that may be a good fit for you. But if you're not able to have that connection, I would encourage you to look elsewhere as well. So, there are so many financial planners that serve the whole spectrum of the market, right? From somebody you can work with on an hourly basis that just takes that hourly fee, and they will give you guidance and set you up, and then you're good to go. And on the other hand, there are wealth managers that will work with you on an ongoing basis through each question that you have to answer for your situations. It may be, making a decision about your investments, making a decision about how you take your pension, or how you take distributions from your retirement accounts. So there are lots of different questions that go into play when you're retiring. And if you have a complex situation, then you may need someone to actually walk you through those pieces each step of the way. So it may be more intensive type of an engagement. But, I do think that retirement is something that is so key. And you're saying you're retiring in 5 years, so you have that runway to really adjust, make course corrections if needed in your situation.
Okay, I will, thank you, Avani. I will direct this next question to Marina. Marina, what do you suggest for 401k savings when your jobs have to change often? So the example here is there's a lack of steady employment and working from contract to fellowships to part-time work. It's confusing. We've seen this, right, at Citi, to how to carry over the 401k from each organization and transfer to the next plan investor. What's your advice there? And in a part of your answer, I'd like to ask if you can address the idea of the importance of taking that holistic view of your personal financial picture.
Yeah. So a couple of things to touch on there is, you mentioned kind of contract employment. So in terms of, I think it would depend if you're jumping around and your sources of income are different. Again, taking advantage of those other types of IRAs or SEPs. And then if you do have a couple of different 401ks, what you can do is roll everything over into a traditional IRA. So that's a good way of keeping everything in one place and consolidated. So every time you move, you just basically request, I would recommend something called a trustee to trustee transfer. If you automatically pull funds and put it back in, there's rollover rules and it can get a little complicated. So if you're looking to kind of consolidate and better keep track of stuff, just make sure you're requesting it's called a direct or trustee to trustee transfer. And that's a really good way of just, keeping everything all consolidated in one place. And if you have an advisor or someone that you work with, they can kind of guide you in terms of how to manage those money and funds. And I do want to quickly add on to, because it kind of all ties together, another thing, in addition to what Avani mentioned in terms of finding an appropriate professional, is also different types of professionals tend to have access to other types of software and things to do scenario analysis, right? So for anyone that's kind of really close to retirement, it's also kind of working with someone and a kind of experienced professional and taking a look and being able to say, like, what does it mean if I get really conservative right now? But I have, another 30, 35 years versus if I, maybe take a little bit more risk or diversify a little bit more. So I hope that answers this question.
Avani, anything to quickly add? We have one more question.
Oh, very quickly, I think that, when you're thinking about retirement, don't just think about your retirement account, right? There is your retirement account and any other savings, hopefully, that you have outside of those accounts as well. And they really have to talk to each other. So when you're thinking about diversification, it's looking at all those different accounts as a whole, because they're all your accounts. Think about them as different pockets in your shirt. It's the same shirt, it's your shirt, they're just different pockets. And you just have to make sure that it's balanced correctly and goes well together.
I love the shirt metaphor. I'd never heard it before last week. It makes a lot of sense. Okay, this one is super straightforward. Either of you can jump in. Does the $19,500 cap for yearly contribution include employer contributions to your 403B, or is that just what you as an individual employee contributes?
Yeah, that is just what you as an employee contributes to the 403B. Your employer can contribute more on top of that. And then also, if you're above age 50, you have an additional, I believe it's $6,000, $6,500 now, of catch-up contributions. So it's $19,500 plus that additional money that you can contribute to the 403B.
And I would just also add is if you have the kind of extra savings and it's comfortable from a cash flow standpoint, try to the extent possible to max out the retirement plan. If you do not, however, to the extent that you have an employer match, try to contribute at least as much to fully benefit from that match.
That's a great point. That's a great point. Okay, thank you both. You've been so wonderfully helpful today. We appreciate all the resources and assistance. To all of my friends at AAMC, again, thank you for having us. Mary Kate O'Hare, thank you for introducing us to this wonderful organization. Monica Valenzuela, you really helped bring this all together, so thank you. On behalf of Marina and Avani, thank you so much. It was our absolute honor to be here with you today. And now I believe Monica is going to say a quick word at the end. Monica?
Thank you. So hi, I'm Monica Valenzuela, Program Manager for AAMC and AAMC Foundation. Thank you for joining our program today, and a special thanks to all of our speakers for sharing your experience, your expertise with us. It's super valuable. A recording will be available on our website, artcurators.org, and please support our capacity to continue programs such as today's event by making a donation today. A gift of any amount will have a direct impact on our work. So I just want to again say thank you. Hope you are all staying well and that you can join us again soon.